So you're using an investment advisor and they're charging you 1% of the amount you have invested with them. The question is that a good deal and should you stick with them? That's a question I received from a viewer named Kelly, and they want to know exactly what they should do. Hey everybody, my name is Rob Berger. This is the Financial Freedom Show, and we're going to tackle Kelly's question in this video. Let me read part of the email that I received from Kelly. They're in their 40s, a professional, and the question was, should I dissolve my relationship with my financial advisor? They charge just 1%, Kelly put that in quotes, as they say. Here's why I'm hesitating. They manage my traditional IRA and one of my taxable accounts, and together it's about 1/3 of Kelly's stock bond portfolio. Mercifully, the portfolio is made up of low-cost index funds from providers like Vanguard, WisdomTree, and iShares. The advisor does not manage a separate taxable account at Vanguard that Kelly has invested in a handful of low-cost index funds. Now, Kelly goes on, the advisor team, including a lawyer, has helped them on a number of other things besides just investing their money, including refinancing a home, disability insurance, and the need to update a trust. So they've gotten more out of the 1% fee than just investment management. So the email goes on. So yes, there is a crushing 1% fee, but is it crazy for me to think that it's maybe really just like a 1/3 fee, so to speak, because of all of the other things that they do for them? And so that's the question. And so what I want to do, I want to give you sort of 5 things to think about, because I get this question a lot. I've had a number of people come to me in emails saying either they're not sure if they should get rid of their advisor or they want to, but they're not sure how. And so in this video, I want to just walk through 5 things to think about. And then I've got sort of a bonus, I guess, tip for you at the end. So the very first thing that I think we need to do is the fee is often expressed as a percentage. 1%, as in Kelly's case, is very standard, but there are some that are higher. I've seen fees as high as 1.75% or even higher. In some cases, they're lower. But here's the key. You want to always translate the fee to dollars, because that's what you're actually paying. You're paying dollars. You're not paying percentages. You're paying dollars. And so with a 1% fee, the math is not that difficult. But if you've got, say, $1 million invested with an advisor and they're charging you 1%, that's an annual fee. So you're paying $10,000 for their fee each and every year. And that's in addition to any fees associated with the underlying investments that they have you invested in. Now, in Kelly's case, the good news is it sounds like they're using low-cost index funds. That's great. But you may have an advisor that's using very expensive, actively managed funds that can charge 1% or more on top of the advisor's fee. So again, you want to understand not only the fee your advisor is charging you, but the fees of the underlying investments. If you're not sure about that, call your advisor. They will be able to tell you. They have an obligation to do so. Now, once you've got that information, again, you want to translate it into dollars, because that's what you're actually paying for the service. And so you want to get that number figured out. Now, the second thing we want to do is understand the long-term implications of these costs. It's one thing to say, okay, it's costing me let's say 10 grand a year or whatever the number is, but what's the long-term implications of that? The tool I like to use for that is a free tool called Personal Capital. I'll show it to you now. This is sort of a demo account that I set up, and it's got roughly $1 million portfolio in all low-cost, these are all low-cost index funds, mainly Vanguard. And you can see right here, once you connect your accounts, it will automatically determine your annual fee based on the expense ratios of the ETFs or mutual funds. And you can see for this portfolio, it's only 8 basis points. This is a very inexpensive portfolio. But if we assume a reasonable level of contributions each year, and I'm assuming an age of 42, since Kelly, the person that emailed me, is in their 40s. And if you go to age 65, even this low expense ratio will cost about $100,000 in fees. And the way Personal Capital calculates that, they look at not only the fees you're paying, but then the loss of the compounding as a result of those fees. And for this analysis, you can change this, but I'm assuming an annual growth rate of just 7.5%. If that were higher, for example, 9%, let's say, then you can see the fees go up. But we'll assume 7.5. But here's the real key. Right now, we're not assuming an advisor fee. If we add the 1% that Kelly's paying, there we go, the fees jump up significantly. And again, this is assuming that you're losing this compounding, which of course you are. This money's being taken out of your account either every month or probably more likely every quarter. And so it has a real effect on your growth. And I think this tool helps us figure out what the true long-term cost of the fees are. Now, one important takeaway, though, is that that tool assumes that the actual performance of your investments will be the same whether you're with an advisor or you're not with an advisor. And so that's something that I think is a very individual and personal question to figure out. Can you handle these investments on your own? It's not hard to set up a portfolio. We've talked about many different kinds of portfolios on this show over the last year or so, but it does take a little bit of work. And most importantly, you have to stick to your investment plan even when the market falls. And for some folks, that's hard to do. Now, an advisor won't guarantee you that you won't make maybe a bad decision in a difficult market, but at least they will be there, hopefully, to try to talk you out of making a bad decision. So there's certainly real value in that. It's just a very personal thing that we each sort of have to assess on our own. But it gets me to point number 3, and this is actually maybe in favor not so much of the 1% fee, but of advisors. They do add simplicity and ease to what you're doing because they sort of do all the work for you. They manage the portfolio. They rebalance it from time to time. They talk you off the ledge when maybe you're going to sell during a bear market. These are all very valuable services that we certainly shouldn't be dismissive of, and I would be the first to say that, even as a do-it-yourself investor. And so that's point 3. There is certainly real value, but the question becomes, is it really worth the 1% fee? And that's where we go back to points 1 and 2, where we look at the actual dollars you're paying and the long-term costs of those fees, because there are many services, and I'll leave some ideas below this video, but there are many services out there that will handle your investments for you for far less than 1%. All right, now point 4, as I mentioned it in the email from Kelly, their financial advisor provides a lot more services than just managing your investments. There might be financial planning. They might give you some advice on insurance. They might help you with trusts and estates issues. In Kelly's case, they helped with a home refinance. And so these are all very valuable services. But here's the real issue. Are they worth the 1% that you're paying? You can go out and get a standalone financial plan. In fact, I was looking at one article. I'll show it to you. This is from Michael Kitces, and a very well-known advisor, has done a lot of great work in this space. Now, this is a couple of years old, I think, 2019, but he was saying here that the average for a standalone comprehensive financial plan is $2,400. So, a financial plan is the kind of thing you get once, and then maybe you update it every 5 or 10 years, or when there's some big life event. But this is not the kind of thing that you're updating month by month, year by year. And so as important as financial planning is, I've never been of the view that it would ever come close to justifying paying 1% of your investments year in and year out. It really is the kind of thing that you should get as a standalone service that you pay either an hourly fee or a flat fee. And that's what we've done. The same really is true for insurance. You can have the certified financial planner as part of the financial planning give you an analysis of things like insurance and how much you should have and what kind, and perhaps with a home refinance, they can advise you on that as well. There's just no reason to give away 1% of your wealth every year for that kind of service that you can get for an hourly fee or flat fee. And with trusts, I just went to a trust and estates lawyer. They charge me an hourly fee. They do the trust, and you almost never have to update it unless there's some maybe change in law or tax code or perhaps a life event. But again, these are the kind of things that don't happen very often. There's simply no reason to pay 1% for that service. And in fact, can you imagine going to a lawyer and asking them to do a will for you? And they said, sure, I'll just take 1% of your wealth each and every year. I mean, it just doesn't make any sense. And so packaging that with investment management and then trying to justify a 1% fee, I don't think makes any sense either. Now, that gets us to the 5th sort of and final point. As you're thinking about what's best for you, Again, one option would be to go to a lower cost advisor. And again, I'll leave some ideas below this video. But the other option is to become a do-it-yourself investor. And here you have to think about a number of factors. The first is, and this may not be the case for Kelly, but in many cases, I've had folks send me the portfolios that an advisor has created for them in a taxable account, and they've got 10, 15, 20, sometimes even more ETFs and funds in this ridiculous portfolio, many of them with a lot of fees. It would be a very difficult portfolio to manage on your own. And unfortunately, they've been with the advisor for a long time, and they have all of these built-in unrealized capital gains. So maybe they'd like to just sell out all of those investments and move into a very simple index fund portfolio, but it would trigger a lot of taxes. Now, there's no one right answer to that. It's something you've got to dig into, look at the details, maybe get some tax advice. But you do need to understand, if you're going to leave your advisor, what have they left you with that you now have to manage? Now, in the case of Kelly, it sounds like it's a fairly simple portfolio of index funds. So if Kelly decides, that kind of portfolio could easily be moved to a Vanguard or a Fidelity or Schwab. If they're ETFs, they can be moved in kind just about anywhere. But you do need to think about, if you leave your advisor, how you're going to handle whatever they've left you with. And if there's a lot of built-in capital gains, that could limit your choices. Now, it doesn't necessarily mean you have to stay with an expensive advisor. Maybe you could find a less expensive advisor to take over that portfolio and manage it for you. But again, if you've got a simple portfolio, like it sounds like Kelly does, then you have far more options. But you kind of want to look before you leap. It may be a good feeling to get rid of that 1% fee, but you got to say, okay, what am I left with, and how am I going to deal with these investments? Now, the bonus point that I want to make, and this it kind of was alluded to in Kelly's email, it's not all or nothing. In fact, I think for some folks, it may make sense to hire an advisor, hopefully not at 1%, but to hire an advisor perhaps to manage just a small portion of your portfolio. It's something I haven't done yet, but I've considered. And the idea being that if something were to happen to me, my wife may, or our children may very much want an advisor to help them. Wouldn't it be great if I could begin to develop that working relationship now, along with, of course, my wife? And then if something, did happen where she had to manage the investments on her own, or eventually our children, we have this relationship with an advisor. Again, hopefully for less than 1%, but we have this relationship with the advisor that she could transition to perhaps all of our investments at that point if she felt uncomfortable handling it on their own. So it's not all or nothing. You can have some with an advisor, as Kelly actually does, and some that you manage on your own. And that gets us all the way back to point one, where we want to translate that percentage into actual dollars. Because if you've only got a relatively small piece of your investment portfolio with an advisor, then of course it's going to cost a lot less than if you had your entire portfolio with them. Look, I know there are a lot of issues involved in this decision, and I won't pretend for a minute that this short video answers all of them. But I do hope that I've given you some things to think about as you figure out what's best for your situation. And as I said, I will leave some resources linked to below this video to help you out. Hey, if you have any questions, leave them in the comments below. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.